Hey everybody, Smart Silver Stacker here. In today's video, we're going to be taking a look at the gold to silver ratio. For anyone not familiar, the gold to silver ratio is basically just a measure at any given time of how many ounces of silver it takes to buy 1 ounce of gold. This is a critical metric for analyzing the precious metals market, and we're going to be going over what the gold to silver ratio is telling us right now in 2022. So let's get to it. Okay, let's not waste any time. Here is a long-term chart of the gold to silver ratio. And you can find this chart over at macrotrends.net, linked down in the description. At the time I am recording this video, with the current gold and silver prices, we have a ratio of approximately 79.5. And as you can see from the chart, this is certainly towards the high end of the range for the ratio. Now, back in March of 2020, when markets crashed and everything, including precious metals, sold off big time, you can see that the ratio spiked up to over 110 for the first time in the past 100 years. And that was obviously an extreme reading and a screaming buy signal for silver, and anyone who heeded that signal obviously did quite well, as the price of silver rebounded sharply off that drop. And the reason that the gold to silver ratio spikes up when asset prices fall is that in a bear market for precious metals, silver typically falls farther and faster than gold, thus driving the ratio higher. Silver is a smaller market than gold, and so as a result it is also more volatile. And while the pair typically does trade together, silver makes bigger moves both to the downside and to the upside. And that is why this ratio typically drops during a bull market for precious metals. You can see that we witnessed this to some extent back in 2011 when silver hit $50 and the ratio dropped below 40. You can also see that in the 1980 bull run, the ratio dropped as low as 15, the lowest reading of the past century. You can also see that this was not an isolated event, and that the ratio has dropped below 20 on 2 other occasions over the past 100 years. So what does the current gold to silver ratio really tell us? Well, when taken together with the backdrop of runaway inflation, global geopolitical instability, record high U.S. trade deficits now in excess of $1 trillion per year, and a massive U.S. national debt that has now officially exceeded $30 trillion with no sign of shrinking anytime soon, I'd say that the current gold to silver ratio is pretty darn bullish for silver. Because at its current level, what the ratio is telling us is that silver is extremely cheap right now. Consider that gold has moved up to nearly $1,900 over the past month, and is now pushing up against its previous all-time highs, whereas silver, near $24, is less than half of its high from 42 years ago. So clearly, as far as precious metals go, silver has a lot more room to move up from today's prices. In fact, in order for the gold to silver ratio to reach its previous low, with gold today around $1,900, silver would need to move up to around $126. Think about that for a minute. And by the way, none of this is investment advice. I'm not a financial advisor. I'm just a silver stacker on YouTube. So take this information for what it's worth and always do your own due diligence. It is my belief, however, that we are in the very early stages of a significant bull market in precious metals. And it's quite normal for silver to lag gold in the early stages of a bull market. But as a bull run in precious metals really gains traction and begins to take off, silver typically puts on bigger gains than gold, particularly in the final stages of the move up. And clearly we are nowhere near that level yet. And the thing about that number, $126 silver, well, that's assuming that the gold price stays where it's at. Historically, however, the ratio compresses as both metals move up in tandem. Silver simply moves up faster. So just going based off of the gold to silver ratio, $126 would actually be a conservative price target for a troy ounce of silver. And if you're getting some value out of this video so far, please do give it a big thumbs up down below. And while you're at it, why not subscribe to the channel? It's my prediction that both gold and silver are going to be moving much higher as investors around the world come to the realization that the Federal Reserve is currently stuck between a rock and a hard place, and will ultimately be forced to choose between allowing inflation to run out of control or triggering a massive recession by raising rates enough to rein it in. And it seems likely to me that faced with this choice, the Fed is going to opt to sacrifice the dollar on the altar of inflation and attempt to keep our current massive asset bubbles inflated. For the majority of politicians, this will likely be the preferred route to take as well, as paying off a $30 trillion national debt would be impossible without first significantly devaluing the dollar. I'm sure they'll publicly bemoan high levels of inflation and probably seek to pin the blame on some kind of scapegoat, but when it comes to fiscal and monetary policy, they will unanimously opt for more fiat currency creation. Another interesting data point we can get from the site usdebtclock.org is this one, the dollar to gold ratio. And what this ratio represents is the year-over-year increase in the M2 money supply divided by world annual production of gold. So basically, if you wanted to back every dollar created this past year with gold and you had access to every single ounce of gold mined, you would need to set a gold price of over $22,000 per ounce. Compare this to the same metric taken back in 1913 when you would have a gold price of roughly $28 an ounce, which actually isn't too far off from the actual price of gold at that time. Certainly a lot closer than our current gold price is to $22,000. And they do provide a similar statistic for silver, which based on today's numbers would give you a necessary silver price of over $3,000. Now, I'm not saying that this is a valid price target for gold or silver, but it does illustrate nicely just how much fiat currency is being created and injected into the system relative to the number of hard money assets that are actually available. And in the case of silver, this is an even more telling statistic because with gold, the annual production is really only a small portion of the total gold available. Almost all the gold ever produced is still around as it is hoarded by banks, nations, and individuals as a store of value. Silver, on the other hand, is a bit different. The above ground stock of silver is always steadily being consumed by industry. Cell phones, electric cars, solar panels, all of that stuff. And so the annual production of silver is much more reflective of the actual supply of silver available. So $3,000 silver may seem a bit pie in the sky. Even I would consider that a pretty lofty price target, but that being said, these stats do show how scarce real hard money is relative to all of the paper wealth that makes up the bulk of our financial system. And if it isn't runaway inflation that triggers a move up in the metals, don't forget that we still seem to be a hair's breadth from World War III breaking out in the Ukraine. One day we have media reports that Putin is pulling troops back, and stocks rally and metals dip, and then the next day Russians are adding more troops and the metals move up. Now, ultimately, I think higher gold and silver prices are inevitable simply because of rampant money printing and debt monetization by the Fed. However, if we do see skirmishes breaking out in the Ukraine, or if the Russians commit to a full-fledged invasion, you can almost guarantee that metals will get a boost as investors flee to safety. In the past, U.S. Treasury bonds and cash have traditionally been seen as safe havens, and so on news of a war, you might expect a pan sell-off in assets across the board, including precious metals. But with the official inflation number at 7.5% and real inflation closer to 12 to 15%, this time investors may decide that cash isn't so safe after all. And if that's the case, I'd expect gold and silver to be the primary beneficiaries. In such an event, I would expect the spot price of both metals to move up significantly, inventories of physical to be stretched remarkably thin, and premiums on physical bullion products to skyrocket. Will the situation in Europe be resolved without military conflict? Only time will tell. But one thing to remember is that the 1980 bull run in silver came very shortly after the Russian invasion of Afghanistan in 1979. So, as for me, when I see the gold to silver ratio near 80, when I see a Fed unable to reverse its easy money policies, and I see a world seemingly closer to open warfare than any time in my living memory, I say it's time to stack some silver. And as for price targets, I think $126 for an ounce of silver really is a fairly conservative estimate over the medium term. I mean, if Tesla can get to a bigger market cap than Toyota, If a Bitcoin can sell for over $60,000, and if the US's biggest export to the world is imaginary electronic fiat currency, then why wouldn't the most useful industrial metal in the world be capable of a 5x return? I really don't see any reason why that would be even remotely outside of the realm of possibilities. But what do you think? Let me know in the comments down below. And if you enjoyed this video and you'd like to see more videos about stacking silver, then check out these right here. Thanks for watching, everyone. Stay safe, happy stacking, and I'll catch you next time. Smart Silver Stacker, out.